Thanks for tuning in to this installment of the Investment Roundtable on Financial Advisor TV. Chris Versace joins me right now. We're going to talk about issues that financial advisors care about when it comes to managing their clients' portfolios. Chris, you've been a regular guest on Resilient Advisor. We go deep on thematic topics, but there's some issues today that advisors really care about. What are your thoughts on the May PPI data?
Well, you can't just look at the May PPI data. I think you have to look at it and, kind of bookend it a little bit with the May CPI report. So when we do that, what did we find? So the May CPI report really pushed back hard on the notion that inflation had peaked previously. The numbers, both the core and the headline were hotter than expected. Then we get the May PPI report that still at very much elevated levels came in not only down month over month, but it's slightly weaker than expected, both on the headline and the core. And what I think it gives us is the notion that the Fed is going to have to go big to fight inflation because, again, in some respects, it hasn't peaked yet. In other respects, it's extremely elevated. And when we look at the CME Fed Watch tool, it tells us pretty much what's likely to happen. For the meeting that gets out tomorrow by the Fed, more than likely 75 basis points. I think it's something like more than 95% expected now. But to me, the one to watch increasingly is going to be the July meeting, and current expectations for that are around 82% for a 75 basis point rate hike. We will get a bunch more data, but what it tells me is that, the economy continues to have that risk concern about will the Fed upend the apple cart, torpedo us, throw cold water on it, whatever you want to say. And, not only give us slower growth, but not stick the slow growth landing and tip us into a recession. At the same time, we know consumers are struggling, but their borrowing costs are only going to go higher. So it's a very delicate tightrope. And if I was giving odds, I can't say that I would be oh so generous to Powell and crew.
Right. So kind of thinking this through as an advisor who's working with clients that generally only consume their information from the CNBCs and the Wall Street Journals and people that are looking for sensationalism, this data is pretty sensational. I mean, we've gone from talking about 25 or 50 basis points this week to 75 across the board. Goldman Sachs, JP Morgan, all saying 75 basis points. And now you're thinking we might be looking at another 75 basis points in July.
Yeah, I think the Fed has shown or communicated that they need to go big. They need to get ahead of this. And thus far, the data hasn't really rolled over in a pronounced way yet. Having said that, I don't think we could expect it to because they only just started bringing interest rates higher. And we know that there's a lag associated with it. Some markets, like the mortgage market, have already turned over faster than expected. We will see some cooling in the housing market. But when we look at some of the areas that are out there, whether it's, energy costs, food costs, or some of the others that are out there, it's going to take some time. And there are reasons to think that with these renewed lockdowns in China, both in Beijing and Shanghai, as well as the EU, kind of shunning Russian oil towards the end of the year, that it's going to be a harder battle than some might have previously thought to get inflation down in a sustained manner. So I do think the Fed really needs to bring out the big stick and go hard, go early, and then it has time to course correct. Remember, there's no meeting in August. And by the time they rolled around to September, the meetings in the back half of September, we're going to have a hell of a lot more data that we can look at. And not just the PPI data, the CPI data, but we'll get the PCE price index for a couple months. We'll have a much better sense about job creation, as well as at least one read on unit labor costs, which the Fed likes to look at. So there's going to be a preponderance of data coming. So to me, the bigger question now is, what's the Fed doing in September? Is it 50? Is it maybe 25? Is the outside chance 75? It's all going to come down to the data. But between now and then, what the advisors need to figure out is exactly what the heck is Powell going to say at the press conference, and how does he instill confidence that the Fed, quote, has this?
All right, Chris, I want to bring Tim Seymour in and get his thoughts on the PPI data. Tim, how should financial advisors look at what we saw this morning?
Well, it's a It's a dialogue that I think is, as Chris is referencing, is evolving, and the data that the Fed is seeing now is different than the data that they had that built their mindset and their rhetoric around the May meeting. And so, I mean, it's funny. Last night on Fast Money, we kind of debated the dynamic of does the Fed go on 75? Is that time to panic? Does that mean we no longer trust the Fed? I mean, first of all, I think there's a lot of people that have questions about whether the Fed is 9 unelected officials who are running the world is a debate for probably a much longer show. The reality is that the CPI data that we got on Friday, today's PPI data, and I would argue that also the payroll data from 10 days ago are ingredients that the Fed did not have at the last meeting. And as we know, the labor component of inflation is the much more troublesome dynamic here. When I was going to business school, I learned about the NIRU, which is the non-accelerating inflation rate of unemployment. I think. How'd I do on that, Chris?
Well done. Well done.
I think, and it was 6%. And anything below that was very inflationary. The Fed is going to be very focused on the labor market, and if they're not already signaling that they want to see higher unemployment, they should start signaling that. I know that's not popular, but again, the PPI data today, no real surprises. Again, a very hot number. Historical references are hard to find to this, and I think even though the good side of the inflation story is one that I think we see relief from before we see it from the labor side, I think there are structural elements of what's going on in the commodity markets, so around food and energy, and especially both the growing cycles and the world that we live in that is not a globalized world as it was 10 to 15 years ago. I think even the good side of it and the PPI side of it is actually going to run hotter for longer. And I'm sorry about that, but the reality is that the Fed needs to, this Fed, and people forget that Jerome Powell is, I know he was walking around in sheep's clothing for a while, but his history is actually more on the hawkish side. Anybody that has followed some of his pathway, and he knows all about how Paul Volcker needed to attack not just inflation in its actual existence, but the concept of it. And therefore, that's why Volcker policy was so aggressive, because we lived in a world back then, and I just can kind of remember my dad cursing about it. But inflation was something that, once you have the psyche of a world where inflation exists, it also means that companies get ahead of the Fed and they don't bring prices down, and they actually do. Inflation becomes that much more endemic if you've got a Federal Reserve that is not constantly vigilant. We heard this story over and over again, so I'll shut up for a second. But today's number, what can I say? Hot number, not could have been worse, could have been better. Doesn't really change the story here.
Kevin Simpson, what are your thoughts on today's PPI number, and specifically through the lens that advisors should be looking at it, not only for portfolio construction, but messaging to clients?
I think Chris and Tim really covered it well, but the PPI has less of an impact, I think, to the retail end user than the CPI. And it was the CPI number that was the sort of the straw that broke the camel's back last week. You were hoping, best case scenario, that maybe inflation was peaking or cresting, not coming down, not getting back to a 2 or 3% level that the Fed would love to see it, but just not increasing and accelerating. And unfortunately, every single category, all of them were higher on Friday, which was a problem. And, Tim touched on the concept of food and energy. So there's a narrative out there, and it's a little bit of spin doctoring where you focus on core CPI. But nobody cares about core CPI. You care about CPI because rent and housing is really important. But if you take away food and energy, well, you can do anything you want to the numbers, because all we really care about is what does it cost to fill up our car and can we afford to eat? So you really can't pull food and energy out of CPI and start talking about inflation. So that doesn't really work. And the other thing we forget about, at least I think on a macro level, is the concept of how petroleum involves every single thing and aspect of our lives from a plastics perspective. So the rise in energy isn't just the gas pump or the $5 a gallon gasoline. it's also every single thing that we use. So the rising prices of energy affect us across the board. And just imagine if China reopens, what that's going to do to the demand pressure for oil as well. So it's a problem. Tim hit that nail right on the head. We're in it for a really long time. Inflation can be a self-fulfilling problem because it's not something where you can put that genie back in the bottle. And your reminiscence of Paul Volcker, and Jay, you're much too young to remember. But if Jay Powell comes out tomorrow and raises 100 basis points, it's still not going to fix anything tomorrow. So we're in a predicament, and the Fed has a really, really tough job. It means that there's not going to be a soft landing. We can hope and pray and do whatever we want, but that's not a reality. And now we just have to kind of face facts.
By the way, why do we have to have a soft landing? I mean, this is the dynamic that I struggle with on the concept of recession and a Fed that has tried to navigate us out of recession and economic cycles. I mean, cyclicality in markets is not only a given, but it's actually constructive in its own way. But that's for another show.
It allows for a period of, quote, healing, Tim. I think you're right. The problem is no one wants to face that. It's an unpopular choice.
Yep.
And if you're a politician, it doesn't work. It doesn't roll bode well. Like we went into a recession on my watch.
But I mean, if again, when Walmart and Target reported their numbers, so those were the reason the market destroyed those two stocks was a function of a couple of different things, including some of the biggest retailers in the world who should have vision into both inventory cycles and things that they do better than anybody, and they failed. By the way, everyone's going to fail on inventory, and they're going to fail. But that ultimately a company like Walmart, even in a recession, if they're not growing at mid-single digits, but they're growing at 1% to 2%, is a company that in the next economic cycle is going to be more profitable, assuming they do things right. And the way the wholesale sell-off of companies that might be facing the headwinds of a recessionary cycle, as an investor in these companies, I actually see opportunities there. I see world-class companies that are well positioned, and if anything, are making investments in certain parts of their businesses that are putting them in a position to be retailers that are efficient and have all the technology and ERP and logistics and dynamics that make companies great today. Anyway. So,
I agree with that, Tim. Having covered cyclicals in the past, you see a lot of those companies during the downturn talk about what they're going to do, how they're going to improve their margin profile, but they almost never get credit until they go through the next upcycle and show that they can raise that bar. Yep. But, to me, the other company to throw in that mix is going to be Costco, just on the retailer front, because it's an extremely different business model than the vast majority of them out there when they get 65, 70% of their profits in EPS generated by membership fees. Very different than Walmart, Target, and the rest.
Yep.
Chris, let's continue down that path on stocks to watch, given where we are. We're in bear market territory now. There's inflation concerns. What stocks do you have your eyes on?
Well, I just mentioned Costco. We could talk PepsiCo, which is, coming down, rather quickly, I would argue. Yet it's probably one of the more insulated businesses, products all consumable. They sell their product across a wide array of grocery stores, C-stores, and the like. And this company has just announced, not now, recently, let's say, their 50th consecutive annual dividend, which tells you that they know how to squeeze the business, good times and bad, and still deliver. So I really like that. Deere is another company that I really like, given where we're seeing ag commodity prices, the upgrade cycle to precision ag. And oh, by the way, Titan Wheel came out this morning and raised their forecast. Applied Materials, Tim talked about, about some reshoring or indirectly hinted at that. Obviously, Applied is going to be great there, as well as the long-term demand for chips. And then one of the other ones we like just as a proxy for infrastructure spending, but also an EV play, is going to be ChargePoint. Just given the growing needs that'll be out there for EV charging stations. But those are some, and I don't want to be a hog and name as many as I can.
Well, Kevin, I know you know a thing or two about Pepsi because we've done some shows together on that. What stocks do you have your eyes on right now?
You know, it's funny. Recently, we rotated out of Pepsi and we own Coke at the moment, but it's not a situation where the narrative changes. It's just sometimes based on multiples. Pepsi, since we've sold it, has gotten a lot cheaper. So much stronger buy here than the exit. Listening to Tim and Chris talk about the Costco's, the Walmarts, the Targets of the world, we had sold Walmart also for a similar reason. The thesis was that when inflation hits, it hits the lower end consumer before the higher end consumer, and tightening the belt is a reality because you still need to get to work, and $5 a gallon gasoline is going to take precedence over certain other things. So looking at those names coming down, those retailers, I think all three of them can be very, very attractive. We're not in any of them. We've owned all three in the past, and I think all of them make a lot of sense. The only stock that we did buy yesterday, and there wasn't a whole lot of buying going on, we added a little bit of Cisco, not the food Cisco, but the traditional old school, old dog tech Cisco. And we like the name a lot. The multiples are pretty low, relatively speaking. You know, they've come down quite a bit. I don't know if the stock's down 30 or 40% from its highs, but you're getting a 3.5% dividend. They have a very strong dividend growth history. 5-year average is around 15%. So it's a good value at this point. But markets, I think, are still in a very precarious position. So you want to be careful. The only other sector I'll mention, and again, not to monopolize the conversation, is I like financials personally. The narrative that they were going to go up with higher interest rates and they were going to benefit, I think still makes sense. But instead of going up, they went down 30%. So Goldman Sachs and JP Morgan are two names that we own. That I'd be very comfortable adding to for all the reasons: dividends, cash on cash, rising dividends, super low multiples. I mean, Goldman Sachs, heck, it's probably 5 or 6 PE. Who knows what the forward PE is? But there's good opportunities here, like Tim said, and it's a situation where you're not trading it, but you're building positions.
Yeah. Tim, let me turn it to you. What stocks do you have your eye on now?
Well, and this is a critical time for advisors to, we have our watch lists. We have our list of companies that we think both, we like the secular story, we like the fundamentals, we like the balance sheets. We think they're going to be able to be bulletproof through these times. But this really is the time to have that list out there, and companies that get to a place where you say, oh my God, I didn't think I could buy this thing here. I'm going to go right into the center of the storm on some level with the interest rate sensitivity and the consumer, and I'll say Home Depot. I recognize the dynamics around the interest rate sensitivity and housing markets. Look, to me, if you can't afford to buy a new house, you're going to fix up the house you're in. I still think at 3.5% unemployment, and even if we're up 0.8 percentage points, significantly higher as we get into next year on unemployment. I still think the amount of wealth that's been built up into people's houses is extraordinary. I think the dynamic around Home Depot, and again, a multiple that, on a forward, 17 times multiple, you're trading at inside a market multiple. You're trading, a company that also dominates suppliers, dominates their ability to really push through higher margin. Their professional business obviously is a very high margin business that I think continues to be part of the reason why they trade at a premium to Lowe's. And so, these are companies that you want opportunities to own. At 250 on Home Depot, which is another 10% down from here, and that's going to be painful for people. But I mean, again, you've taken the stock down from over 400 a share. But you're, again, to the extent that these things mean anything, and I realize numbers on companies and looking at dots on a stock chart on some level, it's not always fundamental analysis, but dropping that into the context of pre-pandemic versus the businesses that got stronger in the pandemic, at 250, I want to own a lot of Home Depot, and I want to own a company that's now basically pretty much taking the top off the teepee in terms of that move that they had during COVID. And again, a company that comes out of this in a world where housing affordability is still a major problem. And I think there's a lot of money that people are putting into their homes. And again, a lot of consumers who are a little higher up on the demographic dynamic that actually will have money, that are healthy. It's very unfortunate what's going on in terms of inflation, and really it is hitting lower to middle class folks a lot harder. There are folks, and we've heard this from the companies that are operating in more the luxury part of the chain. Their businesses are going to stay, I think, pretty strong here.
All right, gentlemen, final question. We have a generation and a half of financial advisors who've never managed money for clients through a bear market. I mean, it's been 14 years. And so you guys are very experienced in those types of strategies and tactics that can help weather those storms. Let's go around the horn. This is an open-ended question. What is your advice for financial advisors as we enter this bear market? Chris Versace, I'll start with you.
Well, if they haven't done it already, I would suggest really concentrating the portfolio down onto quality companies, great balance sheets, dividend payers, the usual stuff. But don't be afraid to own an outside level of cash, and depending on what your level of risk is, you can wade into some inverse ETFs, whether it's SH, that's the inverse ETF for the S&P 500, or some of the others that are out there, so you can actually tamp down the volatility and navigate in a let's say a less than scary path forward.
Kevin,
I like how you call this old in a really polite, calculated way. So after 30 years of doing this, we've seen a lot. We know kind of how to navigate volatility. We haven't really seen, or at least been old enough to remember what the 70s were like. I remember waiting in the gas lines, and like Tim's father, heard a lot of curse words. But the process moving forward is really just sticking to basics, like Chris said. It's funny. In one of our strategies, I've owned SH since 2007, so that kind of dates me and dates the portfolio. But having that as a small piece is something that we've owned constantly for 15 years. Sometimes it may be 3%, sometimes it may be 20%, but it does help to mitigate a risk profile. But the way to navigate any type of markets, good, bad, sideways, whatever the case may be, you own great companies that have revenues. The company's increasing its earnings. Even if the earnings growth is much slower, you're still going to see a stock price that has the ability to appreciate. Home Depot was just so perfectly described by Tim, and that's just a name that we own, and it's a good example. The corpus, the calculus is, let's get paid while we wait. Let's get paid dividends, so when better times arrive, we're being compensated along the way. Cash on cash. I'll leave you with this: the power of compounding only works. It only works in your favor if you can outperform and lose less money in a bear market. Now that's just math, Jay. So I'm not going to burden your brain with the math behind it, but you need to earn less in a down market or lose less in a down market. And that's how you can produce significant outperformance over time. And that's all the three of us try to do.
Yeah, and I would say, advisors, remember what your job is for your investors. I mean, you're not a hedge fund. You're not necessarily, you haven't promised anyone that you're necessarily going to be able to pick bottoms and tops. You've said you're going to own great companies. You're going to be constantly challenging yourself to see if the thesis has changed on a bottom-up basis when the top-down is changing. And so those are just, sometimes this is a time when you will hear from your investors, and this is a time when a lot of investors are suddenly disenchanted because they feel like they're surfing the wave. And in fact, hopefully, first of all, there have been opportunities to reduce risk, but I would caution that as cycles turn, also, the old, no one's going to ring that dinner bell. More managers are fired on the way up than they are on the way down for missing opportunities. So becoming overly retrenched during a difficult period, I think is something people at times do, and then they actually miss market turns. I'm not saying, in the next, week or few weeks, there is something you should be fearful on missing, the FOMO dynamic, no, but I do think you have a case here where you make strong investment decisions by dealing from a position of strength, which is knowing the companies that you're invested in. And despite the noise on the tape, that's something that actually you can sleep with your investors. I will caution that back to the concept of markets people haven't really seen before. If you've been investing for the last 15 years, people have not really seen a credit crisis. And I can tell you that things will get a lot worse as we start to evaluate, credit dynamics that I think are things that people have not really begun to address. So that next leg comes down with really, assessing where we have credit dynamics. And look, lower growth environment on just the macro is certainly the beginning of where companies actually start to get battle tested. I do think corporate balance sheets going into this cycle are incredibly healthy. If anything, by the way, right now, one of the things that's the positive side of all the negativity over the last couple months is that corporate buybacks are really a kind of a record level. That's actually, to me, a little bit of also a perspective on it. Actually, without the buyback activity, these markets would have gone significantly lower, in my view. And there's been some insider buying, and so I feel like positioning right now is actually in the institutional community is actually quite light, and I actually feel that sentiment is obviously awful. So I think there are opportunities to add value for your clients. For me and for us and for what we do, we're not overly tactical, but I think there are opportunities to own great companies in here, and there will be trading ranges. But don't move away from what you do for your clients, which is that I think you are a steward of capital over long term, and you are there to own the best companies and to continue to challenge the thesis around those companies through difficult times.
Gentlemen, that's our time. Thanks to all three of you for coming on, be an advocate, not only for investors, but for financial advisors, especially on a busy day like today where I know you guys have other things to do. Thanks for coming on.